Today, I want to help you understand conceptually what IRR or internal rate of return is. I've spent many hours reading and watching videos about this topic and other ones such as NPV, discount rate, and how all these link together. But for the average real estate investor, you really just need to have more of a conceptual understanding of these ideas. And specifically in this video, what I want to talk about is, what is IRR from a conceptual point of view, go through an example, and then, what are some reasonable expected IRR returns for different types of deals. Hi, everyone. This is Dr. Danny, the multifamily MD. I am a practicing full-time family medicine physician with an interest in wealth building and a focus on passive real estate investing as a way to achieve financial freedom. And in this video, I'm going to talk in detail about what is IRR, but I'm going to do it a different way from a lot of the other videos that you'll find on our IRR. I'm going to talk about it from a conceptual point of view. So you are not going to see any formulas. So if you're interested in formulas, there are a lot of good videos out there. But what I will tell you is that I have studied math a lot. I'm not a mathematician, but I've gone through calculus, physics, and these financial calculations are not that straightforward. And I have learned them and relearned them, and they don't stick very well, to be honest. But what I realized is that I don't need to memorize the actual terms or really how to do it, because Excel will do that for me. But what I do need to understand is conceptually, what does it mean? What is IRR? And so that's what I'm going to get into in this video. So, the technical definition of IRR is that it is the discount rate that makes net present value equal to zero. Yeah, so that's kind of how I felt after hearing that. I was like, what are you talking about? So that, I could draw it out for you and it would be painful for both of us. So what I'm going to tell you is a definition of IRR that my friend and colleague Brian Chavis gave. And he said it is a measure of the efficiency of an investment. So that means that if you put up $100,000 and you get it back in 1 year, plus some return, that is a better deal than if you got the same return in 2 years. So it's a measure of how efficient the investment is, and it provides a way essentially to compare different types of deals and even across different assets completely. So, and the other thing that and I've never heard anyone talk about this, is that IRR and real returns are exactly the same if you're only talking about a 1-year time frame. So I'll say that again because it's a little bit confusing. So IRR and a real cash on cash return are exactly the same if you're talking about a 1-year time frame. So for example, if I invested in a deal where I put up $100,000 and they said, we're going to give you a 10% cash on cash return. And after year one, they, as they predicted, they give me back my $100,000 plus 10,000. So I get 10% return. So if you plug in numbers into these IRR calculators, what you'll find is that if you do the IRR for year one on that same investment, the IRR would be 10%, just like the real cash on cash return would be 10%. Where it gets a little tricky is when you get into, years 2, 3, 4, and 5. And so that's why I thought this would be more helpful if I actually kind of walk through a specific example. So I'm going to turn on my my screen sharing, and hopefully everybody can see my screen now. So these are obviously not real deals. These are just numbers. But what I would say is the top deal here, you're putting in 100,000. In Excel, it shows up as a negative number because it's a cash outflow. And in this deal, you're putting up 100,000. So, for example, this deal up here, this might be a storage unit facility, um, because it will offer a high cash on cash return, but low appreciation. This deal down here, this one would be more like a, like a downtown San Francisco, LA, New York, um, Orlando, somewhere, Miami, basically somewhere where the cash flow is not going to be great, but the appreciation will be more. And what you'll see at the end of these calculations is that the IRR is exactly the same. So I'll walk you through it. So this first one, time zero, year zero, you put up $100,000. Year one, they give you a distribution of $15,000. So you got back 15,000. Year two, you get back another distribution of $15,000. Year three, same thing. Year four, and then in year five, they sell the storage unit facility. And what you'll see is, you get your initial capital back 100,000, plus 15,000. So, storage units, they typically don't appreciate like, downtown apartment complex will appreciate. But what they do is they offer high cash flows. And, there's some different apartment complexes will do that as well. If you're out, in a Class C apartment complex that's, you might see more cash flow, less appreciation. But this is more just so you understand conceptually. You're getting high cash flow, very little appreciation. IRR is 15%. So down here, same $100,000, you get back $5,000 year one. Year two, you get back another 5,000. Year three, you get back 5,000. Year four, you get back 5,000. But then this is the big difference. Year five, you get back 172,500, because this was a apartment building, in a desirable location, and it had a lot of appreciation. And so what you'll see is the IRR is 15%. And so just for fun, if you change this from 172,500 to 15,000, like at the top, look what it does to your IRR, 6.7%. And so what this is basically doing is it's IRR discounts the money you're making the farther out it is. So if you get back your money in year one, your IRR is going to be crazy high. So that we'll delete all these, and I'll just show you what it'll do. So pretend in year one you got back that 172,500. Your IRR is crazy high. You're making 72%. But if you got back zero in year one, and then in year two, you got back 172,500, your IRR gets cut essentially in half, 31.3. So it really is a measure of the time value of money, because, from a practical point of view, if I give you money, $100,000, and you give it back to me a year later, I can do something else with that money. I can keep investing it. But if it's tied up for 2, 3, 4, 5 years, I'm not making any other money on that money. So that is really conceptually what IRR is. It's a measure of efficiency, and it reflects the time value of money. And so, just to give you some examples of what kind of reasonable IRRs would be. So if you are in a very core market where, even if we have a recession, you are probably not going to lose money. So this is a very safe investment. So this would be, Class A apartments, major cities, downtown. So you would be expecting, maybe a 7 to 10% IRR. So if you were, in a city, but maybe a little bit outside of the most desirable locations, that number would get pushed up to 10 to 12%. If you are finding an asset where there's some value to add, either from adding some amenities, raising rents to market rents, doing some remodels, you should expect to make about 13 to 15% IRR. And if you are really, getting into something that's a little bit more risky, maybe it's a building that's half vacant or, very distressed, then a lot of times this is where you're going to see these 16 to 22% IRRs. So, these are all just a reflection of the risk. So the riskier the investment, the higher the returns that investors are going to want. It's fairly straightforward. So thank you for your time. I hope this helps shed some light on IRR from a conceptual point of view. If you have found this information valuable, please give this video a thumbs up. Also feel free to like and share it. For more information about wealth building and passive investing, visit my website, themultifamilymd.com, via the link below in the show notes. And thank you all for your time. And I will see you next time.